Hello, everyone. Pat Smita here from Peachy Lending with your Thursday, March the 20th interest rate update. Now, we did get some important economic news today. Uh, Jobless claims came in a little bit higher, nothing statistically too much. Initial jobless claims were up to 2,000 for the week, and continued jobless claims were up 23,000 for the week. Taken week by week, it's not really a big deal, but we keep getting these gains every week. And eventually that's going to show up in the monthly jobs report. The big news of the day was the existing home sales. Now, this was a grand slam win. We saw that the previous month, on an annual basis, we were selling $4.09 million homes a year. The consensus by the market was about 3.95 million. It actually came in at 4.26 million. What is to note, though, is these contracts were probably signed sometime in December. So whether the current economic conditions that we have affected them or not, we won't know for a month or two. But either way, this bodes very well for the actual real estate market. Finally, leading economic indicators came in lower once again. This is the third month in a row that they were negative. And this is something to keep in mind because these indicators are telling us what's going on in the economy. And the fact that we got a third consecutive month of negative indicators should be something we pay attention to because the Fed's going to be looking at it to see if they're going to cut rates or not. Now, intraday technical analysis for mortgage-backed securities. Remember that interest rates are affected by two big things: the mortgage-backed securities and the 10-year bond yield. Now, the mortgage-backed securities, the higher the value, the lower the interest rates. Today, we did start off very well. Mortgage-backed securities were actually very much higher, but then started to retreat. So what we had a lot better rates in the morning, but toward the afternoon, we did see that interest rates started coming back up again as the values came in lower. And we see that we did try to make a run for this key level. If we would have broken it, we would have had some brand new rates that we haven't seen in months. The same thing happens on the bond yields, the 10-year bond yields. Remember that when the 10-year bond yield goes lower, interest rates go lower. And we saw the same thing. We did see that the 10-year bond yield went lower, broke into new territory, only to retreat toward the end of the day. So once again, we saw rates a lot lower in the morning, but eventually they went back to really yesterday's levels by the end of the day. Now, on our scenario that we look at every day as a comparison, the rates didn't really end up moving. They ended up being roughly the same as yesterday because of that retreat that the market saw on the mortgage-backed securities and the 10-year bond yields. Finally, if you like what you see, please follow us, like the video, comment, and share with your partners and clients. And we look forward to talking to you tomorrow.